Hey there, everyone, and we are live. I want to thank you so much for joining me today. My name is Mitch Goldberg. I'm a financial advisor with the wealth management firm Client First Strategy. So if you're new here and we haven't met yet, it's Mitch. I would love for you to join in on the conversation and ask me questions during the live broadcast. Words of encouragement are always appreciated as well. So when we go live here, what we're looking to do, you and me, we're looking to make you the best possible version of your financial self, the best you could be financially. I want you to be well in all aspects of your life. And I hope I can do that. But I'm not so full of hubris and pride that I think I can do that. But helping you be better off financially, that is definitely something that I would like to do. So without further ado, we've got a couple of things to talk about, okay? So let's roll the banner. New things you should learn about your risk tolerance now that the stock market has rallied over 20% off its low, and answers to your most pressing credit card questions and overall credit questions in general. Look, folks, these are important things. Everybody is participating in this closed economy of ours. So we're going to roll the introduction. We have some very important topics to cover, and I want to get to your questions. So let's go with the introduction. And we're back. So it's a beautiful day in New York. It must be, about 70 degrees and sunny, barely a cloud in the sky. I've got my windows over here, and it's just beautiful. So I wouldn't blame you if you weren't watching my live stream because you were out enjoying the weather. But if you're watching in the replay, I'd like to welcome you to that as well. And if you're watching in the replay, go right ahead, ask your questions as if you were watching this in the live, because I will keep an eye on them. I will get to you. I will answer your questions. And I will be grateful that you watched. So first of all, let's do a quick market update. We're going to share screen. Share screen. Okay, we're going to share. For me, it's my left screen. I've got a couple of screens in front of me. Okay. Ordinarily, I would say today was a great day. Ordinarily, I would say that today would have been a fantastic day. Like if we closed yesterday up over 7% on the major averages, we did up over 7%, really solid rally, really solid day. And we only gave back, let's say, a few tenths of a percent, 12 tenths of a percent, 16 tenths of a percent, depending on which index you're looking at, 0.33% on the NASDAQ. Ordinarily, after a day like yesterday, I would say that is an incredible day that we had such a big rally, because we've had these gigantic rallies followed by gigantic retreats. And I can't stand that. I've been saying that I would rather have, up days of 100 to 200 points in the Dow, down days 100 to 200 points in the Dow. I don't really like the wild swings. If we're going to build on a rally, I would rather build on it over time, because I feel that way it'll have staying power. It'll have stickiness to it, as opposed to this just massive volatility, which really confuses and scares the heck out of investors. And it makes people guess, like, what the heck is going on? Is it the end of the world, or is it just, the next 6 months of recession, maybe, batched into one day? And that's what the market does. The market it's known as a discounting mechanism, the stock market. It's not always perfect. That's why there's an old expression. The stock market has predicted like 9 out of the last 11 recessions, or 11 out of the last 9 recessions. Okay. The point is, it's not always a perfect indicator. But when we have the stock market will discount an event, a recession or recovery, and now it starts to discount the recession after the next recovery and then the recession after that. So you're getting these giant swings, I think, because markets in a way are sometimes looking too far ahead. Okay. Like good times will go on forever or bad times will go on forever. But the reason today was not, to me, a really good day when ordinarily it should have, is because if you paid attention to the market during the day, the Dow, I remember, was up at one point 900 points today. So that was incredible, but we gave it all back. And to me, that and went into negative territory. So to me, that really takes away from the day. A giant pop that all fizzled at the end of the day. All three major averages came down. So I wasn't happy about that. And the VIX, I don't know if you can see this, the green VIX over here. Okay. That's the fear gauge. Okay. That was about 80 or so a few weeks ago. And it's coming down a lot. So the fear is coming out of the market. That's what this indicates to you. But it was up over 3% today, when all day long it was lower all day. So that to me is an issue with this day, with this trading day. It's not something that I'm particularly thrilled with. Okay, so let's take a look at a couple of the movers. We've got a few things to talk about. I will stop sharing the screen. Okay, now you have you like my background, by the way? Background on the stock market. Okay, like ticker symbols. I love my green screen technology. So what we have to look at first of all is your risk tolerance, because personal finance is more important than the stock market. I know we focus on the stock market because of the immediacy of, it's up, it's down. So you could really see your net worth go up and down in real time based on the stock market. You don't see it in your house. You don't even know if your house is going up or down in value because people aren't trading, your neighbors aren't trading their houses on a second to second, minute to minute basis. If they did, then you would know the value of your house in real time. So let's keep that in perspective, that the minute to minute trading is really not that big of a deal overall, especially when you're a long-term investor. We know that, when you make an action right away in the stock market because of panic or because of a lot of anxiety, that's called a panic decision. But when you step back, separate yourself with time and space from your anxiety, and you make a decision, it's called an action. And sometimes you have to take actions. Action could make you feel better, and that's okay. So that's what we have to do sometimes. So in this case, I want to talk to you about your risk tolerance and ask you, so what happened? The market, a month and a half ago, mid to late February, was at an all-time high. Everybody was sitting pretty, and everybody expected the good times to last. We've gotten the rug pulled out from under us with the coronavirus. The economy of the U.S. basically shut down in Western Europe as well. And it's been a slide. About 3 weeks ago, we hit the bottom of this bear market so far. Not to say we can't see a lower low. Citigroup, Goldman Sachs, and one other analyst in another firm have all come out and said, don't trust this rally. We're due for another, a new low. The thing is, so many people are calling for a new low that I'm wondering if it's going to happen. When everybody starts to call for the same thing, usually the opposite happens. That's the funny thing about markets. We'll see. We'll see how it goes. Yesterday we had a rally because look, I want to choose my words carefully. People are dying from coronavirus. People are suffering horribly from this virus. Family members are suffering horribly. So when the market goes up, because we had fewer hospitalizations, lower deaths than the day before, I don't think that's something to celebrate. The market went up, but the market is not celebrating the market. Okay, the stock market is a discounting mechanism that is calling a turn in the cases. Okay, so I just want to get very clear about that. Okay, I have friends whose loved ones are suffering from this disease, and it's an awful thing. Your risk tolerance. And then a lot of people got scared. A lot of people thought maybe they have to sell. What should they do? Perspective is needed. And the prescription from me, from my financial advisor brethren, has been hold on to what you have. If you already had an appropriate asset allocation based on your risk tolerance, your time horizon, you'll be okay. The best thing is probably to do nothing for most people. But you might have found that your risk tolerance wasn't as high as you thought. So now that the market's rallied, and if you think about it, the major averages aren't really down that much year to date. I mean, they're down. It's a tough year, but it's not a disaster like it was a few weeks ago. So it's not too late to make a change. It's not too late to say it's time to reallocate. Pick a better allocation for you. You don't have to do it all at once, but maybe you had too much in stocks. It's okay. I don't blame you. A lot of people got complacent because the stock market kept going up and up and up, especially from like the middle of 2019 all the way till the first 6 weeks of 2020. So I wouldn't blame you if you got caught up a little bit and you didn't rebalance soon enough, or you just maybe took too much of a shot on Beyond Meat or something. Okay. Or you have to decide that what your risk tolerance is. The best way to know what your risk tolerance is when you go through a bear market, because then you'll realize how you feel about it. And if you just can't take the pain, I would use this rally that we've just had as an opportunity to reassess your risk tolerance and make sure that your overall portfolio is in alignment with your risk tolerance. Okay, so now could be a time for you to change. What I like about the market right now is that some of the consumer discretionary cyclical type names are starting to work. These are the kinds of companies, the stocks that work when, hey, Scott, how are you, buddy? So I see Scott out there. Thank you for joining. These are the kinds of things that you have to take a look at. So that's one thing. Now I want to answer some important questions, because one of the casualties of a bear market and a recession, and we're in a recession. A lot of people maybe haven't felt the full effects of a recession because it hasn't been long enough, but it sure is pretty deep. And if you've lost your job, you certainly feel it. They say, what's the difference between a recession and a depression? A depression, well, let's say a recession is when your neighbor loses his or her job. A depression is when you lose your job. Okay. So now people are all of a sudden finding themselves in a position of not having enough money to pay their bills. We know that there's a very low savings rate in the United States. And now it's coming back to haunt people. And now, instead of saying to you what you could have done, what you should have done, and be done with it, I want to tell you what you could do now. So first of all, a couple of things. I've got some notes here. And by the way, if you want to know how I know a lot about credit scores and raising them and credit cards and all that, it's because I read. I read a lot, and that's what you have to do in order to learn about this stuff. So first of all, according to PayScale, this recession we're in could set people back 5 years if you're working for a small business, maybe 2 to 3 years if you're working for a mid-sized business, and less if you're working for a large company. Not to say large companies didn't have furloughs or layoffs, okay? According to Career Builder, bartenders, wait staff, and athletic coaches are the ones who took it the hardest. Okay, so that's one thing. People are running through their savings quickly, so you need to pull back, preserve cash, and what you need to do is do it in a way that hopefully won't destroy your credit. What's different about this recession compared to past recessions is the CARES Act for helping small businesses and consumers with the payroll protection program and the economic disaster loans. But if you're an individual, there are a couple of things that you could do. Okay, first of all, don't just stop paying your car payment or your credit card payment or your mortgage payment or whatever. You could call the financial services companies that you're doing business with, and some of them actually have to give you what's called forbearance. Forbearance means they could put things on pause. You don't have to pay for 90 days. It won't hurt your credit score, and you'll come back with some kind of plan, maybe to pay more interest. And usually it doesn't mean you have to pay back everything at once that you had forbearance on, but some kind of plan to help you get through. And some of them will even extend it. But the key is, don't just do it. This is not automatically built in. If you are 30 days late on a payment, you are considered late. It gets reported to the credit rating agencies. not 29 days, but 30 days. That's when it gets reported. And every financial institution pretty much does the same. Okay. So that's one thing. 80% of Americans are worried about paying their bills over the short term. We spoke about the forbearance. And by the way, you could call the credit agencies like Equifax, for example, and you could actually ask them to put a code on your credit report. It won't necessarily raise your credit. It's like it's a metric. You could have them put a code called AW. I never knew this until I looked this up today. It's a disaster code. And after Katrina and other natural disasters in the country, people are able to do this. So at least lenders could see that you were going through some kind of disaster or you were in the middle of a disaster zone. Look, if you were in a Hurricane Katrina, for example, and your credit was terrible because your house was washed away and you lost everything. It took you a while to get back on your feet. Maybe you were in Long Beach, New York, for example. At least let the lenders will know that you were in a disaster zone, so you can do that. Okay. The other thing is this. And I've made a couple of videos about credit ratings, about how to raise your credit rating and what goes into it. But a lot of people don't know this, how a zero card balance transfer works. And even if you have very good credit and everything is fine with you, there's a lot of people watching who might want to know about this. So just be patient, because we've got a few things to wrap up and then I'm off. I've got a few housekeeping things to take care of with you that you're going to have to hear. So when you move money from a credit card and do a zero balance transfer, how does that affect your credit score? Over the very short term, what happens is you get what's called a hard pull, and that lowers your credit score typically by 5 to 10 points, and it'll stay in your credit score for about 2 years. But what you gain is obviously zero interest on the money that you've been able to move over to that zero balance card. Plus, because you have bigger credit lines, your credit card utilization rates go down. So having a lower utilization rate is actually favorable to your credit rating. So overall, the two are a wash short term, but long term, it's better for you, providing that the credit card debt is not because of a problem that you just can't afford to live your lifestyle. Because if you're just going to run up your old credit card again, that's not the point. Then you're just delaying the inevitable. Okay. So that are a couple of things. Now, there are a couple of other things that go into your credit card, your credit agency. Really wanted to change my green screen here. I kind of forgot to do it when we're talking about credit cards. Here we go. How's that? That's a nice green screen. That is really nice. Yeah, I like that. All right. So a few more things about credit cards. The age of your credit history is very important, and the age of your credit cards is important. So when you bring on newer credit cards, you reduce the average age of your credit history. That hurts your credit score a little bit. That's maybe about 10% of your credit score. But paying your bills in full and on time and utilizing less than 30% of your available credit card debt, those are the best two things that you could possibly do for your credit score. Okay. Now I just want to take care of a couple of house cleaning things. Okay. I was talking about volatility before with somebody, and that's what we're seeing. We're seeing massive volatility in the market. That's why I started this presentation today about the volatility and how I can't stand when you have these giant down days, these giant up days. I would love to see this bear market. It used to be painful to see a bear market dragged out over 9 months or a year. So now we've got the complete opposite, where it's dragged out in the space of a few weeks. But volatility, the way I would describe it is volatility is like a roller coaster. You're going to feel it in your stomach with the big ups and downs in a roller coaster. But the people who get hurt are the people who get off the ride too early. I just love the way that sounds. I'm glad I brought that up. Some housekeeping things. I want to share my screen with you again. Share screen. Okay. All right. Here's an article from Credit Karma. By the way, again, I learn about this stuff from reading content on websites like Credit Karma, CNBC. and others. Okay. So tomorrow, I want to show you this. I thought I had this pulled up before. It takes forever to pull up a screen when you're live streaming. I guess live streaming uses up a lot of your resources. But tomorrow morning at 10 a.m., I will have the pleasure of speaking with a friend of mine for the FPA, the Financial Planning Association. I'm a member of the Financial Planning Association. I'm in the Long Island chapter. Financial Planning Association is an organization for financial planning. It's all over the world. And I'll be speaking tomorrow to a group of maybe 40 people or so, maybe more. I haven't gotten the latest numbers, but we'll be speaking tomorrow. And Mark Badami, a friend of mine, is the chapter president. So he'll be asking me questions. We're going to have more like, I guess, a fireside chat about the economy, what it means, and how financial advisors could speak to their clients about it, and some issues about it in practical terms. So I'll let you know how that goes. Hopefully I'll have a video of that out and posted either tomorrow night or Thursday night. So I will be doing my LinkedIn Live tomorrow, even though it's the first night of Passover, because Passover doesn't start till about, I guess, an hour and a half later. I will be skipping my live presentation on Thursday night. The stock market is closed on Friday for Good Friday. I'd like to wish everybody a happy Easter and a happy Passover, a sweet Pesach, I'd like to say. So I am not positive if I'm going to be doing, you know what? I'm going to skip Friday. Okay. I'm going to skip the live show Friday. The market's closed. I'll consider it a 3-day weekend. So let's go with that. So I just wanted to let you know. Now I'm going to take a quick look over here and see who's out there from my LinkedIn world. And go to activity, go to posts. I like the timestamp we're in. I guess it's nice weather, so maybe not as many people are out. But Cerurium, thank you very much. Hey, Howie, good to see you, and I'm glad you like the backgrounds. I have fun with backgrounds. Having fun with backgrounds, that could be like a show unto itself. Okay, and then a few people out there on Facebook. Hey, Scott. Hey, Sue. Great to see you. Already said hello to Scott. Thank you. Great to see you, Sue. And Russell, I know you're out there. You've always been a great supporter, and I appreciate that. That means a lot to me. Hey, Tom. Good to see you out there. So glad you guys are here and joining me. So that's it. I'm going to end this one. It's about 23 minutes. It's about as long as I like to go with these, episodes. You're watching Be the Boss of Your Money with Mitch Goldberg. I'm here every weekday at 4:30, except for this Thursday. I'll be taking off for Passover. I'll be taking off Friday for Good Friday, and I'll be back the following Monday. You have a great day. If you have any questions when you watch this in the replay, you let me know, and I'll get back to you soon. Thank you.